So one day after the deal closed, I'm the only one with equity in the deal and do not know this. Okay. I have no idea. I just feel like they're great partners, they're family, whatever. And they've taken all their equity out of the deal. So lo and behold, COVID happens. And this was supposed to be a easy cash flowing investment for us. Philadelphia was one of those places that, shut down and all hell broke loose. And this was the only hotel in our portfolio that we actually closed. And we had done capital calls in our portfolio, which everyone who owned a hotel did, and other real estate, and it was pretty common. So when we called this partner to make the capital call, which is pretty small, maybe it was 10% or less of what we thought was their equity in the building, they said, we don't think we're going to fund the capital call. Like, there's just not a lot of incentive for us to do that. And I said, what do you mean? I mean, you guys have like $25 million of equity in the deal. This is only like $1.5 million or $2 million capital call.
Jake, good to have you on the show, man. Good to see you.
Good to be here. I'm happy to do your show. You did my show. I'm lucky to be on your show. It's awesome.
Classic rule of reciprocity. I'm excited to get all these lessons from your years in investing in hotels. I think you guys are at 19 plus hotels, $1.5 billion of transactions. Is that still kind of the modern accurate numbers?
Yeah, we're adding, I think, a 20th one to the portfolio in about a month here, which is probably the most exciting deal we've done. So that is going to be a lot of fun. We've sold 2 hotels this year, which is also exciting. Printing is always a good time as well. So yeah, it's constantly in flux, but that's the count. That's where we're at.
Okay, awesome. So today we're going to talk a little bit about your investing journey, your investing career, both on the fund and operator side for hotels. We're going to talk about how the hotel industry is just generally in transition, and you guys are raising a GP vehicle, which I want to hear a little bit about as well. But take me back. How did you get into this business? What's your background?
So I started in the business as a kid through my dad, and my dad grew up with not a lot in Queens, and he came basically from the bottom to the top. He worked in the back room, sweeping floors, and he eventually worked his way up, got jobs at Hilton and at Hyatt on the corporate side. And he met my mom, and my dad was always very focused on the food and beverage side of the business. And this is, back in the day in New York, like that was a huge powerhouse thing where these big hotels would be the center of the whole town, the community, and they'd have these big events. And that was kind of his love of the business. And he met my mom, and my mom's dad was a great businessman from Philadelphia with a lot of money. He had a bank, he had a bunch of real estate. And basically, my dad and my grandfather partnered on 3 hotels. So when I came into the business, we had 3 hotels. It was like a family enterprise. My dad was the hands-on operator as well as the owner. And the company was basically built out. There was no real room for me and space. And I could have joined the business as it was, but I was always an entrepreneur and wanted to do things differently and saw the world slightly differently than my dad did. But my dad had this great reputation, and we had this management company that was really known in the Philadelphia area. But the mentors and the people that I looked up to a lot of times were like the Barry Sternlichs of the world, and how you were raising money from other people and creating these investment platforms and investing in hotels. And maybe you were connected with the management company, but maybe you weren't. So I really wanted to grow an investment platform. And when I graduated law school, I had the grand idea of raising a $30 million hotel fund where I had full discretion to go invest in any hospitality asset that I wanted. And, I fell flat on my face, because what normal investor is going to give a kid with basically no track record right out of law school $30 million to kind of blank check invest in hotels? And what everyone said is that go find your first deal. And my dad never raised capital from anyone. It was always with my grandfather and maybe one other family that was kind of connected. And he didn't want to be involved in the capital raising. And he said, if you want to do that, you go do that. And you can kind of leverage off of our reputation to help you start that side of the business. So that was how DoveHill was started, and that's the investment platform of our business. But it came from one deal. And I remember on the first deal, we literally had to scrap together to try and find our share of the deal, which we joint ventured with a landowner to build a hotel in Philadelphia. And we needed like $7.5 million. And I could barely get to 2.5 million. I got to 2.5 million, still needed 5 million. Thankfully, our partner was amazing. They're like, we can kind of front it for you. Let's just start the construction. Let's keep things moving. We know you'll get the money. And then I ended up getting the balance of the money from a small mid-scale private equity firm. And they came in for $5 million, and the deal was really successful. And then from there, capital raising has been a combination of high net worth and family offices and institutional partners. But it started just the gritty way and raising capital from anyone who would talk to me.
Yeah, I've similarly had a grand vision in the past of raising a ton of money when I first get into an industry, falling flat on my face, talking to a bunch of people. They tell me I'm not experienced enough, and then, like you said, you have to really pick that deal and build up from there. So maybe just tell me about that first deal. Like, how did you find it? What was the deal? Were you building a hotel? Were you buying a hotel? What was the context, and how did you know, or how did you think it was going to be good?
Yeah, most of our deals have come to us off market, which is a really cool way to get deals. And when we were capital raising for our second co-invest fund, we actually put together a slide that showed the source of all of our deals. And like 95% of them came off market. This first deal came off market. And my dad had this great reputation in Philadelphia for operating hotels. I had graduated law school, spent like 3 weeks in France, and I remember I was on the plane back, and my dad, sent me this deal. He's like, let's look at it. So I was underwriting it literally the entire plane, like, in Excel. Like, I had no team. It was just me. So I'm doing all the work. And it was a ground up hotel. And this is 2011. It was a home two suites, 248 rooms. It was going to be the largest home two suites in the world. And this was when Hilton just launched that brand. And it was kind of a limited service, extended stay hotel just below the Homewood Suites brand. And this was an A-plus location in Philadelphia, right across from the convention center and the Reading Terminal Market. And the great thing about this deal is our partner had already teed up all this funny money from the government. They got all this incentive money from the government to build the hotel. They had lined up the bank. They had lined up the contractor. They had done all of the pre-development work, everything. And they're really smart people, but they couldn't get financing because, back then and even today, in order for a bank to get comfortable on a deal, they want to know that someone with hotel experience is in the capital stack and has control. So we were brought into that deal to be the hotel partner, to be the sophisticated hotel person to give the bank comfort. And that was how the deal started. So we co-developed it in a joint venture with our partner. And it was a great example of how partnerships work, because we've had some ones that are a little bumpier since then potentially, but this one was amazing because everyone knew their role in the deal and it just worked well. They were great developers and great builders. They didn't know anything about hotels, so they would like defer to us for all the hotel stuff. We obviously knew how to build a hotel. We'd done that a few times before, so we could weigh in on best practices. And the hotel opened in 2013. Because of some of the tax credits and the structure, we had to hold the hotel for 7 years, but we sold it literally at the height of the market in 2019 for a huge number. And at the time when we built it, it was the first new hotel built in Philadelphia in like 10 years. There's just not much supply because Philadelphia's construction costs are high. And we would have probably not been able to build it had we not got all this funny money from the government. So I think our cost on the deal was like 48 million and we sold it for 95 million. So it was a huge win. And there was just a ton of cash flow along the way. And, it made it really hard to have first deal be that good because it was a high bar to match.
Yeah, I remember I was reading the a book about the Koch's biography. They run like a huge multi-hundred-billion-dollar empire, and one of the kids had to run a family business that totally failed, or it really sucked. And his dad said, "I'm glad you didn't succeed because you would have thought you would have basically leaned more on being good than lucky, which is sometimes what happens in business, right? You're just lucky." What did you learn
100%.
from what did you learn from that deal? It seems like you don't do any more branded hotels, or certainly not Hiltons. What are some other things that you learned, or maybe what are some takeaways from that initial project?
Yeah, we still own 3 hotels, but I think hotel development is very difficult. And the hotel development that the only development that I would consider today is like the best location in an amazing market where everyone wants to be, but also where someone that owns the land or another developer has basically taken it 90% of the way to the point where you can start construction. We built a hotel last year, the Moxie in St. Pete, and it was the same setup. And it's a real great way to get into a deal because you're coming in at the end and you don't have the time burn, the energy burn that they've spent maybe on 2 or 3 years. The deal in Philadelphia was actually, it was going to be a W hotel, but kind of the condo crisis in '08 happened and blew up those plans. So this was a resurrection of an older deal. And that was a big benefit. I also learned the value of partnership and that your relationships and your word are really everything. And our partner was just an incredible family and group because when I didn't come to the table with the money, they still believed in us and they knew we would get there. And then what happened is I ended up getting there. We got there. We got this $5 million private equity investor. But because, we were late, I basically went to my partner and I said, hey, they're going to pay me this pretty nice promote if we hit it. Why don't we split it? And they can come in the deal and we'll kind of be three-way partners, but we'll split the promote. You and I will do it 50-50. That way you'll get some benefit. And I think that went a long way to them. And it really set the stage for a good partnership. And obviously we left money on the table, but it kind of built a friendship and created opportunity for more deals down the road. So those are a few things that I learned on the kind of development partnership side. On the operations side, a limited service hotel in a city can be incredibly, incredibly profitable. And those are some great hotels to own, whether they're branded or unbranded. In this case, it was a beautiful Hilton hotel, Home2 Suites, but it was just very, very profitable because these limited service hotels, like you see it in New York City, we for a time had an investment in the Courtyard in Chelsea. They basically draft behind all these hotels with huge ADR, but you don't have all the cost structure that they have. So there's some good flow, but you can also be in a situation where you're just in a city with low rate and it's not that good. So it's very location dependent.
So that one was a grand slam, it sounds like. What are some instances where you guys made a mistake or something didn't go well? And I'm curious, what were some of the learnings and takeaways from that?
We've probably made every mistake you can make. I can go through a bunch of mistakes. Keeping it in that same deal, and I've talked about this before on some other forums and on Twitter and stuff, but in 2019, we sold that hotel. We were invited in by the buyer to invest in the hotel again. And they want us to manage. They thought we were doing a great job. And we understood the buyer to basically be a family office. And they had some interesting wealth preservation strategies, which, in my opinion, turned out to be a sham. And it became a very, very bad partnership. So we bought into this new deal. And part of the structure was they wanted to set up a ground lease. And they were going to own the ground lease 100%. And we were going to manage the hotel and joint venture in the building for 25% on our side and 75% on their side. And as part of that, we would manage it. But in 5 years, they had this interesting clause where the ground rent escalated to a number that I thought it was just a little bit too aggressive, a little bit too high. And we were thinking about it like a more of a stable investment that, we know the hotel really well. It's going to be a lower yielding investment, but it's pretty safe because we've been in here for so long. And I set up a put right where in 5 years before that escalation happened, I could basically put my interest to the partner so that they could buy me out and they would own 100% of the building and 100% of the land. Well, as it turns out, the fallback on that put right that I set up was if you fail to buy me out, you have to like give me all your interest, right? They were collateralizing the buyout of my right with their own interest in the building. What they would do is they would take the ground and basically donate the ground to a university and get a huge tax write-off, presumably. And this is just what I can assume. We never really got the full details. The numbers were pretty interesting. So they bought the hotel for $95 million. If I remember off the top of my head, they valued the land at $25 million, which I was kind of like, yeah, whatever, that's fine. And then they valued the building at, let's say, $70 million. And I think we got maybe $40 million or $45 million of debt, and we put up like 25 or 30 million of equity. We were 25% and they were 75%. And without our knowledge, what happened is the day after we closed this transaction, they refinanced the ground. They put debt on the ground at a $50 million loan sizing. Remember, they had valued it at $25 million with a CMBS lender. And this was the time when CMBS lenders were just throwing money at everyone. But because they had this kind of interesting ground rent structure and payment stream, they could get that sort of financing. And because they were able to finance the ground for $50 million, that took out both their equity in the ground, which was $25 million, and their equity in the building, which was roughly $25 million. So one day after the deal closed, I'm the only one with equity in the deal and do not know this, okay? I have no idea. I just feel like they're great partners, they're family, whatever. And they've taken all their equity out of the deal. So lo and behold, COVID happens. And this was supposed to be a easy cash flowing investment for us. Philadelphia was one of those places that, shut down and all hell broke loose. And this was the only hotel in our portfolio that we actually closed. And we had done capital calls in our portfolio, which everyone who owned a hotel did, and other real estate, and it was pretty common. So when we called this partner to make the capital call, which is pretty small, maybe it was 10% or less of what we thought was their equity in the building, they said, we don't think we're going to fund the capital call. Like, there's just not a lot of incentive for us to do that. And I said, what do you mean? I mean, you guys have like $25 million of equity in the deal. This is only like $1.5 million or $2 million capital call. They're like, yeah, we just don't see a lot of upside for us to do that. And I just didn't understand what they were saying, because the hotel before COVID was performing, it was going great. And then they said, well, why don't you just exercise your put right and we won't buy you out, but we'll just give you all of our interest in the hotel. So I'm sitting there, the hotel's closed, it's the middle of COVID. I remember I was at my house and I'm talking to them on the phone. I'm like, what do you mean you'll just give me all your equity in the building? They're like, yeah, we'll just accelerate the deal we had in 4 or 5 years and you could just have our interest in the building. So I said, okay, we'll call you back tomorrow. So I immediately got on the phone with my lawyer and I said, something's fucking wrong. Like, this doesn't make any sense. And they called me back in a couple hours and they said, do you know there's a mortgage on the land for $50 million? And boom, no. What do you mean there's a mortgage on the land? And then I start running through the numbers. We figured out like kind of how the CMBS was structured. We did our back of napkin calculation of how they could have gotten a mortgage of that size. And boom, there you go. So, fast forward through some very threatening litigation and other things to expose what I thought was some unsavory business tactics. We ended up taking control of the property. And it's still been a pretty tough deal because of the financial structure that we kind of inherited. But it was a real learning lesson that you can never assume that your partner's objective is the same as your objective. And you should always really ask what the objective is and not just assume what it is. And, we assumed what it is. Now, I'm not going to say what I think really went on, but, that's not how you treat another partner. So it's a real extreme case, but there was a big learning there. And the hotel's performing well now, but it was very challenging for a lot of years.
Yeah,
so that was one that went
that
bad.
sounds horribly stressful. I can only imagine. Is there something that you could have done in the operating agreements or the language in hindsight that would have either limited their ability to do this or would have notified you if they did this?
Um, Notification would have been fine, but it wouldn't have stopped them from doing it because I didn't have any control over the land.
Hmm.
The thing that I tried to do is I tried to get a personal guarantee from the principal to take me out of the deal on my put right. And their counter to that was, we have enough equity in the building. We have 25 million. We were only, they had 3 times the equity that I had. That should be sufficient for you to get the comfort to, not take a personal guarantee. Now, that's a true statement when someone actually has skin in the game, but when they refinance out all their equity and they have no skin in the game, it doesn't work. So I think that's the only thing other than not doing the deal that
Okay.
we could have done.
Okay. No, I appreciate you sharing that story. I mean, I think there's so many lessons in making business mistakes. I think that, far less lessons in being successful and far more lessons in the mistakes that we've made in the past. So it's
And the mistakes,
good to hear some of that story.
I mean, the mistakes are fun, but it adds it adds some excitement. And you want to learn from your mistakes because that's how you're going to be a better business person going forward. It's kind of like the saying where I was listening to Patrick O'Shaughnessy's podcast the other day, and I think this guy, Alan Waxman from Sixth Street, was on, and he was mentoring some younger people on his team. And he's like, guys, before you have a family, before you have kids, now's the time where you have to put in the work. And it's similar to mistakes. Like, now's the time earlier in your career is where you want to make the mistakes. And you're going to make mistakes later in your career too. But it's not being flippant to investors, but now is the time where you really want to understand all the nuances and, make a lot of mistakes. And obviously there's risk that goes along with that, but people make mistakes all the time. So it's important to, keep pushing and not let the mistakes get the best of you and move on to the next thing, or fix the mistake and not let it get you down.
What do you think are so hotels is kind of a unique asset class, even like within real estate. And I'm curious, what do you think are some of those uniquenesses and challenges relative to investing in apartment buildings or single family homes?
So it's funny. I think a year ago we launched an industrial vertical, and it was kind of like a side thing because I had been tracking some industrial real estate in Fort Lauderdale, Broward County, in some very valuable land areas. And this has been going on for years. And finally, a year ago, I pulled the trigger and we ended up buying 2 industrial properties, or sub-institutional. And it's so funny because industrial properties are literally the opposite of a hotel. The cash flows are predictable. You are immune from expenses by way of a triple net lease structure. Your CapEx is non-existent. There's no operating business. It's just a pure play real estate investment. A hotel is almost the opposite. It's both a real estate investment and an operating business. And I think sometimes where people get into trouble with hotels is if the real estate is misaligned with the operating business. And what I mean by that is you can have a very profitable hotel business where the real estate is just not worth a lot. But that means you can't really pay a lot for the real estate component. You're really just buying the operating business. Or you can have an A-plus location where the operating business is not very good and you're not making a lot of money. I mean, there's some luxury hotels in New York that might fit that category. Or maybe the holy grail is where you have, and this is a hotel we're buying now. It's, I hate calling it a trophy asset, but it is a trophy iconic asset. The real estate is incredibly valuable and the operating business is incredibly valuable by virtue of its reputation and its current business and growth prospects and everything else. So you have to know what type of hotel deal you're buying. And if you confuse yourself which one you're buying, you could have very misaligned expectations with you and your investors.
What's a situation where the land isn't worth too much, the actual real estate, but an operating business can be worth a lot?
Yeah, I'd say those would be more like limited service commodity hotels, like a Hampton Inn on the side of a road where you could have a great business, but you can buy land very cheap and there's minimal barriers to entry, and someone could build a hotel across the street from you. So for a time, the operating business could be very durable because maybe you're the only hotel in town. The land's not that valuable, but you're printing money. But then if four more hotels move into town, the operating business starts to potentially suffer. Maybe it doesn't, but it could. And that would be an example where the real estate or the building isn't all that valuable and special. Similar to office, there's certain hotels that are just kind of obsolete now. Hotels were built maybe in the 80s or 90s in a certain way for how people lived, how people traveled, how people did business. And that's changed. One thing that I think is very interesting to point out, and why for at least direct equity investing that we're doing, we're focusing a lot on very unique experiential type assets, is because there's a lot of other places that are filling the need of, call it 3 to 4 star hotels. So let's take a Marriott. Okay. If you have a Marriott hotel and you have a nice ballroom and you're in a suburban market, well, 10, 15 years ago, you were the only game in town for a meeting, for a business dinner, for a wedding, for an event, for people to stay. Now you're not the only game in town. And in fact, people prefer to be at other places for those type of events. So now people are getting married in a barn. They're getting married in a field. They are having business meetings at a gastropub or like a beer hall type of thing. And they're doing more experiential type of events, or they're having an offsite somewhere and they're not going to the offsite at the suburban Illinois Marriott. So there's a lot of business plans that were great 10, 15, 20 years ago that people are still going to try and value add and fix, but I think they're going to be very hard in some cases to fix. And it's all building and market specific.
And your group, you guys, it sounds like you will build hotels, you'll remodel hotels, you'll manage hotels. You also have a fund, maybe like a pref fund. Can you walk through the different stacks of kind of the capital and the management that you guys do?
Sure. So we have two separate businesses. So on one side, you have DoveHill, which is the investment and asset management side of the business. And then on the other side, you have Wurzak Hotel Group, which is the management company. They both have separate employees, separate P&Ls. I'm the CEO of both businesses. Maybe there's one or two employees other than me that kind of share between. Obviously, there's collaboration, but they're completely separate businesses and they run on their own, both profitably. The management company operates 11 different hotels, and they just actually launched a third-party program where they can manage now hotels for other people. All the 11 hotels that we currently manage are owned by the investment side of the business, DoveHill. The management company has a lot, probably over 800 employees. We have a corporate infrastructure that provides services to all the hotels. And we really specialize on full service and lifestyle hotels with the food and beverage component. On the investment side of the business, that's kind of where all the little single purpose funds we have two co-investment funds, and both of those are housed on the investment side of our business, and all kind of development, project management activities happen on that side of the ledger as well. During COVID, we launched a co-investment vehicle. And the strategy of that vehicle is to invest in preferred equity in hotels and to invest in other distressed or impacted hotels from COVID where we thought we were getting them at a good price. We've since launched a second co-investment fund because it's been so successful. And the strategy of the current fund is preferred equity again, because I love that. And then the second pillar of that is unique and experiential hotels. We're going to take direct equity positions. It's not going to be preferred, could be preferred, but it's mostly going to be common. And that's the focus. And the other unique thing that happened at COVID is we started investing in hotels that we didn't manage. And we did that through these preferred equity transactions where the management wasn't broken. They just needed capital for a variety of reasons that you could imagine during COVID, but the management of the hotel was fine. So that was a good experience for us because we got to hone our asset management skills with other operators. From me, because I sit on both the management and the investment side, I also got to see firsthand how other operators operate, which was really fun. If you bought a similar business or made an investment in a similar business, you have a front row seat to see how a competitor or colleague business is operating and it's neat. And you can really size yourself up. You can make adjustments. You can also make recommendations to the other business.
So during COVID, you guys made an investment in a hotel in Chelsea with the preferred equity fund. I guess one, tell us a little bit about what a preferred equity fund is and why does it exist? And then two, maybe through the lens of that deal, walk us through what happened, how much did you guys invest, and how all that worked out for you.
Yeah. So preferred equity is basically the holy grail of investing if you structure it right, because it allows you to create an asymmetric return where you're earning an outsized return for the level of risk that you are taking. And you can certainly screw up preferred equity and mess the return and the risk up. But we really got good at setting up these structures and finding the deals, which were all off market. And one of the things we focused on were deals that were below what big institutional funds would do. So we were doing deals with an institutional partner, by the way. We did about $60 million with one partner. Deal sizes range from $7 million to $20 million. On a one-off basis, a private equity firm probably wouldn't look at those deals because they're too small. But on a portfolio basis, it really became a good investment for this partner. So we were investing in a place where there was not a lot of competition, which was really good. And most of the deals came off market through our network. And basically, we would invest the preferred equity in front of all the equity, just behind the debt. So preferred equity's magic comes into play because we get all of our money back and a return before the common equity gets anything. So it allows you to get the benefits of an equity investor, like tax benefits, depreciation, loss, capital gains, but with a similar risk profile to a credit or debt investor. And what's interesting is there were all these credit funds that kind of bubbled up in the past couple of years. And credit investing is great. I mean, some of the wealthiest people in the world are credit investors. But what we really like about preferred equity is we get all the same rights as credit investors, actually even more rights because we're already in the investment entity. So if we need to take over, we can do that. We don't need a court to get involved to do it. But we are treated like equities. So instead of our income and returns being current income, which is taxed at a high rate, obviously, it would be capital gain income. And we get deductions from depreciation and other losses depending on what's going on with the property. So it's very tax efficient structure. And we would do it at a leverage point, which probably never went above 75 or 80% loan to values. There was still what we viewed as a pretty good margin of risk behind us. On the Chelsea deal, that was another one, came off market. It was a family that owned the hotel and they needed capital because the hotel was closed in the middle of COVID. Marriott was managing it. It was historically an amazing performer. They were also going to do a renovation. They needed some money for that as well. And we came in, made a deal with the existing lender so that we can come in. And I think we invested $11 or $12 million in the deal. And we had a minimum return hurdle of, I think it was 1.7 times our money, a 17.5% IRR. It was the greater of those two things. And then we had the right to force a sale or a liquidity event of our position in 4 years. So what happened with that deal is we got a bunch of cash flow along the way, which was great because the hotel opened and it started performing really nicely and New York's still on fire. And then when it got to be almost 4 years, we went to our partner and we said, hey, we want to, get out. So you either have to sell the hotel to take us out or you have to refinance. The hotel was doing so well and we were at such a leverage point where he could refinance us. So we were refinanced out of the deal. And when you combine the amount of money we got from the refinance with all the money we got from the cash flows, it was something like a 1.8 times return. And it was phenomenal investment. I wish we had more deals in New York City right now.
That's great. That sounds like a grand slam as well. So now that we understand preferred equity and where it sits in the stack, can you talk a little bit about why you have a fund that does common equity since you love preferred so much? What's the reason for it and why does it exist?
It'd be fun to just do preferred. I guess, all day. But at the end of the day, I'm also a entrepreneur. And when you're preferred, you have certain controls, but you're really like a partner, like an institutional partner. You know, you're not running the day-to-day business. We think we can add tremendous value also running the day-to-day business in the right deals. So common equity allows us to do that. It's also obviously taking more risk, but the return should be better. We don't want to be doing common equity deals where the risk is higher and the return is less. So in those cases, we'll be doing preferred equity. But in our experience, the big asymmetric upside on preferred equity eventually runs out because the market gets more efficient. Either maybe, debt starts to get looser, new equity players come into the market, there's a improvement in economics, there's more liquidity in the market, whatever it is, it eventually dries up. It dried up during COVID. The COVID run lasted maybe 2 years, and we're in another run right now because you had, instead of during COVID, there was one issue, it was COVID. Now you have like four issues. You have the meltdown of capital markets where interest rates had risen two, three, four times, and borrowers need to extend. You have massive deferred property improvements that need to get put into place. You have loan paydowns that need to happen. You have maybe LP investors that are willing to get out of the deal and take a discount that want liquidity. So there's all these reasons for preferred equity now, but I think eventually the need won't be as prominent. So we want to have another thing to do as well.
Okay, so common equity, more upside, also gives you room to be operational in the business. Preferred equity sits above that, potentially lower returns, but still great returns and a safer place in the stack than common equity. And then senior lenders is a different beast by itself. Um, I want to try something, and we could just riff and test this and see if it works.
Let's do it.
Take a look at our Montauk offshore property. See
Okay.
if you can pull it up on your side. And I'm just curious, if you can poke around, look at the picture, see where it's at, and tell me, what are we doing wrong? What are we doing well? What would you do
Just on the
differently? What do you
website.
website? Look at some of the pictures on Google Images, see where it's at.
Can you, well, I looked at this deal with you, at its infancy. Can you tell me what's happened, what's transpired with the deal since, we talked about it maybe over a year ago?
Yes, yes, happy to update you. So we bought this property, I think, a year and a half ago or so. Um, this was really the first deal that we did. Actually, the way we got into this is we invested in a hotel management business, and they were great managers. So we thought to ourselves, okay, we should actually start owning the real estate. So we found this property in Montauk. It was 75-year-old motel, which nobody had invested in recent times. The owner had actually passed away. His kids had never been in the business. And it was just the definition of like a dingy motel. But the location was pretty cool. So it's right downtown in Montauk, next to the only grocery store, and it is sandwiched between the lake and the ocean. So it's like 20 feet away from the beach, unobstructed views onto the ocean and to the sand. And then on the other side, you have these sunset views onto the pond. So we thought to ourselves, this was a good kind of setup for us to do a hotel flip and really turn it into a high quality product. So Marley led that project, and I think it turned out incredibly well. I actually have only seen it pre-opening because I've had a kid since it opened, so I haven't had a chance to fly out
Congrats.
there. But so far, we've been open for a few weeks. The reviews so far have been good. Um, and we still have kind of like a plan and a vision to like build out a restaurant and kind of really turn it into like a property that's a little more experiential in nature. But right now it's really nice hotel rooms, steam rooms, sauna, hot sauna, cold plunges, like gym, like big beautiful pool, all central, and then like beach service on the beach. So that's where we're at with that property.
Well, it looks really nice. I want to pull something up. I can't think of the name of this. Let me pull it up real quick because I want to. Okay, here we go. So, first of all, from the pictures, your design looks very nice, and it looks very fitting to what I would want in Montauk. And for those that don't know, there's a hotel in Montauk called the Maram, which like kind of really set the standard. KSL bought it during COVID after the original entrepreneur owned it and set it up. And it was just a real cool execution. And the owner made a lot of money. So when I go to your website, first of all, I know who designed your website, Tambourine. They design a lot of our websites. They're great. I don't get the vibe that I should be getting when I come to your place. Like, I feel like it's missing something and it needs to be more robust. So one thing that I always like to see is right at the top of the bar, a gallery bar, so that you could click on the pictures and really understand what the hotel is. And that would be, photos of your public space, photos of the local area, photos of the room, outside photos, like maybe you have a pool, maybe you don't, like all that kind of stuff. So people can find it very quickly. And maybe you're still in the process of making your imagery, but I want to see more of that. The other thing that I want to know is like about the location, the neighborhood. You described it beautifully. I don't see that from the website, and you need to see that. You need to understand where the hotel is, like, because people know Montauk, but they also want to see like young, cool people having fun kind of at your hotel. So that would be some things that I would add. And then I think in your room section, that's great. Your spa looks cool, but at the top of your website it just says spa. Like, don't even know that your hotel has a spa. Like, it just says like rooms and spa. It seems like it has more stuff going on at the hotel, but I don't know what they are. There's these guys called Blue Flag Capital. They got money from Bain Capital. They own the Fairway in Nantucket. So I just pulled up that because I thought, okay, it could be like, let's just see what their website looks like. And the top, their menu bar is the hotel. So obviously there's a bunch of pictures of the hotel. It's like what the story is, what the vision is. That would be cool to know. There's a gallery. Boom. You got to always have the pictures. Rooms, eat and drink. Maybe you guys have food. Maybe you don't have food, but it'd be good for people to know like what you offer, what the setup is. And then there's a neighborhood section so people can figure it out, where it is, what the story is. And they also have something cool. It says like their story. And I think I would like to see you have a story section because it seems, I like the name Offshore because it actually makes a lot of sense given the location you just described. But it seems like a brand that you could actually turn into a brand with multiple hotels. So it'd be really good to know what the story of the brand is, what the background is, what your customer looks like, what you offer at the hotel. Like, it would be fun to know what Offshore is.
Yeah.
That's what comes to mind.
I love it. I appreciate that feedback. I agree. The Fairway has a wonderful header image, good website, good like feel for the overall property as you kind of scroll through it. I love it. Yeah, I agree. I think we have a
Branding,
lot of work
all
to
that
do
kind
on
of
the site.
stuff. And by the
Yeah.
way, what we've been successful with, and I'm happy to share the group we work with, but you can get these influencers to come to your hotel, and the influencers now, the good ones, make such amazing content that, we require all them to give us the content. It's like content that you would have paid $10,000 for before, but you get it for free doing like a trade or whatever with them. And I haven't popped onto your Instagram, but assuming you have an Instagram, like you could just flood your Instagram with all that cool content, and immediately people would figure out what the hotel is about. And you could probably take the videos they create and pop them into your website too, which would be pretty fun.
Do you guys do most of your social in-house, or do you guys have like an agency that you like to work with?
I think they're called C3 Creative, but where they're managed in-house. And then Tambourine does some websites for us. We use another company for digital marketing, like SEO and ads on TripAdvisor and all that kind of stuff. But the influencer side of the business and the social side of the business, I think is managed by a company called C3 Creative, but I
Okay.
can confirm that we've gone through a few of them. You know, you really gotta, like, social media is easy. You could tell like if someone's good or bad, but
Yeah.
these guys have been with us for a while. And essentially how it works is, you know, you guys are more of a seasonal hotel, so you would do it potentially a little bit differently. But we have, like, so the Moxie, for example, in St. Pete, we opened almost a year ago. We had influencers coming every single week, and they were coming to our restaurants, they were coming to the hotel. So we're just getting massive amounts of content that we're using, that they're using. And then we have professional photographers and videographers come once a quarter, where there's like more stage photo shoots where we have models and different things like that. But that's a great way to keep all of your social looking fresh. So every quarter, and you might, because you're in the summer, frankly, do it every month in the summer, you could now fill this for the whole year with all the stuff that you create over the summer.
I'm curious, how do you think of food and beverage? Do you guys manage that internally, or are you usually looking for a partner depending on the location? Do you lease things out? Like, because these are some things that are on my mind too. Because offshore is going to need a restaurant. Our Zion hotel has a little tiny restaurant, and these are kind of remote locations. And I'm just, I've heard of horror stories on the F&B side, and then I've heard some people be successful with it.
It's funny because, like, I hate the restaurant business, but I love the hotel business. But I think it's hard to have a really successful, amazing hotel without a great restaurant or a great food and beverage experience. You know, I think if you don't have that, you're kind of just like an inn or like an Airbnb situation, like a pre-Airbnb Airbnb, and that's fine. But the food and beverage is the opportunity to really build loyalty, to really build a connection. We're buying this hotel in Maine, and I think a huge amount of the rate and the performance of the hotel comes because they have this famous restaurant there. So it's important. We have most of the hotels we operate ourselves. We are looking at doing a lease now in one space. It all depends. If you have a standalone kind of operation where you could get a clean lease out of it, that might make sense. If you have a restaurant or a outlet that's very integrated with the hotel, that's more of an amenity for hotel guests, and you have the ability to operate it, then you should probably operate it yourself, because the restaurateur's incentives are not going to be aligned with what you need to do at the hotel and the service experience you need to deliver for your guests, because they're paying a certain rate. And then we have a rooftop brand called Sparrow, which we operate now in 2 hotels, that is great. And we do it all in house, and it's run by our team. It's a lot of fun. So it just depends. One structure that I'm seeing a lot more of is a like a consulting agreement where maybe you work with, I'm not going to say a celebrity chef, but a real restaurateur, and they basically figure out your restaurant for you. They figure out the menu, they figure out the uniforms, they figure out the OS&E and all the plateware and the design and all that. And you run it with your staff and your people just to make sure that you're aligning the interest and expectations of the guest. But then they come in quarterly or every 2 months to just tune in and make sure things are going right. And that's a situation that I've seen to work really well. And what probably those used to look like were management agreements, where there's oftentimes a lot of misalignment, where you have a fancy chef coming in and they don't really care about the bottom line, and they're just blowing all kinds of money to support their reputation, but they're not making any money and you're paying for it. If you have a consulting arrangement, then you're paying someone for the consulting, you're paying a good fee there, but you're controlling your P&L. You can do whatever you want.
Got it. Yeah, I've looked at a couple of these consulting firms. I think that makes a lot of sense for what we're looking to do. It does worry me to bring an external partner into in-house, and then, how does it affect our hotel, especially if it doesn't go well. But also, I'm with you. Like, I think the hotel business is a much better business than the food business, and I'd prefer not to be in the food business if I can avoid it. My first job was at a waiter, and I watched that restaurant had amazing food, and mediocre service because I was providing the service. But I watched that restaurant, which is a beautiful restaurant in Santa Barbara, just slowly crash and burn. Like they were just losing money every month, and
It's
the
tough.
owner was very stressed out about it. It really broke my heart. So that probably
The
traumatized me
the
from,
juice is never worth the squeeze. You only do it for the love.
yeah. Yeah, and I'm a hardcore capitalist. I can't just do it for the love. It doesn't work for me.
Yeah,
Um,
it's tough.
so where do you see the hotel industry going? Like what has happened in the last 5, 10 years, and where is it migrating to?
Well, I don't know if it's migrating here, but certainly what we're focused on from an investment standpoint is very unique and independent hotels. I think hotels have gotten way too commoditized. And the hotel business was never a commodity business. It was always a family kind of business. And all the great hotels that I like staying at all have a unique feel, all have a sense of place, all have a story. And a lot of hotels have gotten very utilitarian. And maybe that's okay. But I think the prices that people are paying for utilitarian experience seem like it might be hard for that to continue. And I also think that the business traveler has changed and the kind of corporate group traveler has changed. So to me, the leisure and transient segment of the business seems way more durable and valuable because those people have made it very clear through COVID that travel and experiences, especially our generation, is the most important thing. And we will cut out other things in our life before we cut out doing an amazing thing with our family or having an experience with a friend. So that's going to continue to be at the forefront. But there's always going to be a need for, economy, Motel 6 type of hotels. I just don't think it's worth all the effort and the risk. I'd rather be in the multifamily business.
That's a really interesting point. It also seems like with the rise of social media and that being the primary method of discovery, that more experiential hotels will just take advantage of that free traffic and continue to boom, right? Like my wife refuses to stay at, a Courtyard Marriott or nicer, like she wants to stay at the boutique hotel that is smaller and has like fine touches and it's been promoted across Instagram. She can kind of look it up
That's
on
where she's
TikTok.
found it.
Yeah,
Yeah, she saw it on
exactly.
Instagram, she saw it online, and that's what's exciting. And I also think people in our generation are they want to go to the place, but they also now want to go to the hotel in the place. So I think some people might say, I want to go to Puglia, Italy, and I don't care where I stay. Okay. But a lot of people want to say, I want to go to Puglia, Italy, and I want to stay at the Borgo Ignazia or something hotel, right?
Hmm.
They are going to the place and the hotel, and like both are equally as important. So that's something that's not changing. That's just going to continue and get more and more
Yeah, and
profound.
I've noticed that there's just, I mean, maybe this has always happened. Maybe I'm just in the age group now, but there's a lot of talk of what hotel did you stay at, right? Like, oh, we went to Cabo, we stayed at the X, and you either get a very positive reaction or you get a muted reaction, and people are seeking the affirmation from the positive reactions.
Well, it's
Like
kind of like it
there's a
says
lot
something
of
about you.
Totally. There's a lot of connectivity around like, hey, we stayed at the Thompson in Cabo or whatever. And you're like, okay, like we are now part of the group of people that stay at the offshore in Montauk as opposed to something else. So it is an interesting trend to
Well, it
see.
also like set describes who you are. Like, are you when you go to New York, are you an Upper East Side, like, want to live in the Vanderbilt, the Snob, and then near the park, which I love staying up there? Or do you want to stay at like the Nine Orchard Hotel, which is like the hippest hotel in Chinatown now, or downtown? And like, where do you want to be? What kind of experience do you want to have? Who do you want to also be staying with at the hotel? Like, I know people. I'll tell you this. I've started to get turned off by hotels in Europe, particularly that I'm seeing too much on Instagram or too many
Mm,
people that I see on Instagram going to that hotel because I feel like it's been played out now. Like it's become a check the box thing that people have just gone. It's like, wait a second, I've been going there for the past 3 or 4 years, and you know now everyone's showing up. It doesn't feel as cool or as special, so you got to find the new place. And sometimes it could be a turnoff, like if it's too much of the scene or too much of the thing, because you don't want to travel across the world to then see half the world that you live with in that place.
Yeah, that's fair. That's totally fair. One last thing I wanted to talk a little bit at, because we covered capital stack, the preferred capital, the common capital, the senior debt. One I guess element that I've become keyed into more recently is the GP fund, right? I have a few friends that are raising the GP fund. I think you mentioned that you're raising the GP fund. Can you tell me a little bit about what that is and kind of why is that important? Why is that kind of attractive to you?
Yeah, it's important for a few reasons. One, we had people coming to us and saying they would basically give up the ability to pick and choose what deals they want to invest in if they could give us capital, have us have the discretion, but maybe get better terms than someone that's picking and choosing the deals that they want to invest in. So that was one reason, and we saw an opportunity to do that. The other reason is it's nice to have capital to kind of put yourself out there as someone with conviction that can take down a deal. If you can raise a fund, you can raise capital deal by deal. Raising a fund is very hard. So if you're trying to buy a hotel or make an investment, if you have this vehicle already set up, even if it's not all the money you need to invest in the deal, it gives the buyer or the counterparty, maybe the joint venture party more faith that you're going to be able to execute and close on the transaction or close on the deal. So for us, that's very important. And the other thing is it allows us to scale up to bigger deals and not have to, be solely reliant on personal capital. Because as everyone's experienced over the past 4 or 5 years, we have a lot of investors with liquidity issues because they invest in a lot of private deals and those deals haven't traded or they're stuck in a VC fund or whatever it is, and they have some illiquidity. Having this co-invest vehicle allows you to bolster up that liquidity, which is important to keep the engine going, to keep everything moving. And it gives people access to multiple deals with maybe a single investment that they're going to make.
Yeah. So on the usefulness to you, for example, you can use it to go hard on capital, right? There might be like a $2 million deposit that you need to go hard on, and then it's not just your own capital. You have this GP fund that you can pull on. Also, if you're doing a $200 million deal with equity deal with private equity, they may need you to put in like $2 to $5 million, right? And you may not have the personal liquidity
More.
to
Yeah.
do that. And
Yeah.
candidly, like
Exactly.
you probably don't want to put in that much money into a single deal. So having this GP fund
Exactly.
allows you to scale up, do a bigger deal, still get the benefit of doing those deals if it's a good one, and then um, and do it from the fund. And then from a or from an LP's perspective, they get to invest across a range of deals and they get slightly better economics because they're participating in your magnified kind of carry structure
You got it.
on those bigger deals.
Yep.
Okay,
Exactly. Exactly.
awesome.
Yeah, and we found it to be a great structure. We're currently still raising our second GP fund, and we had our first closing. Wanted to do a couple deals. We did one deal. Now we're closing a second deal, and now we'll go out and finish capitalizing that fund. And the other nice thing it allows us to do is if we need to move quickly on a deal, or if we need to take a deal down, depending on the size, we can use. I think in our fund, it's maybe 30 or 40%. It's probably, I think it's 30% of the fund to take down the deal. So let's just say our investment in the deal is only going to be 10%, but we have a slight gap or we need to move quickly on something. We can invest a larger amount and then kind of fill it in later, give people a slight return and put the money back into the fund.
As somebody who's had to syndicate capital, I can see an incredible value from that because we might be like a couple million off, and then we have to commit that capital, which is a lot of money from our group, and it's scary. So being able to like access that capital and have a fund that's specifically dedicated towards it would really really help for sure.
Exactly. That's it. That's the story. And by the way, everyone has a GP fund, okay? The biggest institutional investors in the game have GP funds. They just don't tell you about it. They have a GP fund. So they exist for everybody. And, you should be proud of yours if you have it. And it's a great vehicle to make good investments.
Awesome. Jake, this has been an excellent conversation. You've built a wonderful company. I'm excited to see where you go with it. What's the best way for people to stay in touch, follow you, get involved with the projects that you're working on?
JakeWurzak.com if you want to connect with me. And then if you want to connect about any of our deals, just go to our website, DoveHillCos.com. We've made it really easy for people to kind of get access to our flow. And then we met on X, which is so much fun because like it's cool meeting people in real life on X. So at J Wurzak on X.
Okay, cool. Give Jake a follow. Check out his site. I'll talk to you soon, Jake. Good to see
Thanks,
you.
man.